webinar in our 2015 series. We continue our focus on the Green family, all 4 generations, and their drama. They're bold and beautiful, they're young and restless, and we'll paint their portrait of risk and look at ways to protect the family and the family business. How will we do it? With insurance solutions tailored to meet their needs as they travel through the days of their lives. They all have just one life to live, but that life will be filled with glee at times and with passions at others. But through it all and across all the generations, they have a guiding light, a trusted team with you, their fee-only financial advisor, and LLIS, the advisor's insurance advisor. Each month's series lasts about 50 minutes, and our narrators know that you have burning questions. And since they are performed in front of a live audience, feel free to be interactive. Type in your questions, and we'll do our best to answer them timely or at the conclusion of the show. Today's episode is being recorded and will be posted to our website within a week in case you missed a pivotal moment in the story. And throughout 2015, loyal fans will receive 10 CFP-CE credits, 1 for each month. The more you tune in, the more you know. Today's narrator constantly monitors the insurance and financial services industries to continue building the LLIS dynasty. He joined the LLIS cast in 2003 with his CFP and his MBA, and has been our executive producer as president and CEO since 2013. And ironically enough, Mark's wife is a teacher, a university adjunct professor, and Mark is a family business successor. So who better to present the teacher and the family business successor, Mark Maurer.
Hi everybody, this is Mark, and today we're going to be talking about the greens. And how you know we're talking about the greens is because it's October. That means it's 88 degrees here in Tampa, but probably gorgeous wherever you are. And so we are going to start with the greens. And throughout 2015, these have been your clients. There are 4 generations of them as they move through the phases of life with different financial needs as they seek to protect against uncertainties and to deal with upturns and downturns. Here's what you missed last month. The flying carpet and its employees. So we talked about how to reward employees with salary continuation, bonus plans, or split dollar coverage. How to keep employees with key person buy-sell, or how to even use life insurance to secure a loan. And we talked about using disability insurance and long-term care insurance for employees of the flying carpet, which is Ben's business. So let's look at our family tree of our 4 generations. And if you've been following us, you know this family pretty well. If you haven't, if this is your first time tuning in, welcome. And so just to go over who everyone is, we have the A, B, C's, and D's. Andrew, the patriarch, he's the A. Barbara and Ben are his children, and Mary joined the family. Claire, Cameron, and Carl are all direct descendants of Andrew. Get it? The A, B, C's? Pretty clever, huh? D's, Deidre, Daniel, David, Diana. A, B, C, D. Pretty neat. But what we're going to talk about today are Carl and Jenny. Carl's in the family business with his dad, the flying carpet, and Jenny's a school teacher. Let's talk a little bit more about Carl. Well, he's 35 and part owner of the family business, the Flying Carpet. And if you don't remember what the Flying Carpet does, the Flying Carpet manufactures carpet for airplanes. Again, get it? The Flying Carpet? All right. We got to do something, people. It's October. And he's married to Jenny, and they have 1 daughter, Diana. And Jenny is age 39, and she's a school teacher. So we have our business successor and our school teacher. Now, Carl being 35, he's a Gen Xer. And the younger Americans are, the less planning they are doing for the future. But the numbers aren't great for older Americans either, with 50% of Gen Y, 35% of Gen X, and 25% of baby boomers having done absolutely nothing to prepare for retirement. And for all of those clients, if they are already behind and already far behind, what happens if an early death or disability stops or decreases any of that income that they need to get to retirement? And the lack of planning for the future could be tied to current financial fears and instability. 84% of those in Gen Y, 83% of Gen Xers, and 66% of Boomers said that they had financial concerns, with 42% of Gen Y and 31% of Boomers concerned about paying off monthly bills. It's been one of their #1 financial concerns. And again, how do we pay our monthly bills if there's no income coming in? And I love this cartoon here. Gen Xers were especially concerned with their ability to retire. Well, those aren't Gen Xers. They're on the left, obviously, but may have to adjust their retirement date as well. 48% said a top concern is not being able to retire when they want to. But only 9% of those people said the most important piece of financial advice was to save for retirement. So they're concerned about not being able to retire, but they don't really think it's that important to save for retirement. And I, being a husband, like they're in the picture, although I have a little bit more hair, I want to make sure that my wife has a comfortable retirement and that one day we aren't in front of one of you and you're telling me that instead of retiring next year, it might be 20 or 30 years from now. Now, more than 2/3 of adult Americans have life insurance, but fewer than 1/3 have disability coverage, even though for your clients and even yourselves, in your income earning years, even though disability is 6 times more likely, we don't have it as much as we do with life insurance. And the error reflects what is sometimes called the availability bias, a mental shortcut that we use to gauge risk. So we rely on images and emotions that easily come to mind, and we tend to ask what's the worst or best that could happen. I remember reading a book one time, and if you ask people if they're afraid of living next to a nuclear reactor, 99% of people say that that scares the heck out of them. But those same people think riding a motorcycle is perfectly safe. The odds are of anything happening living next to a nuclear reactor is infinitesimal. The odds of being in a motorcycle accidents are, that's just a flip of a coin there. But we don't think of the motorcycle as dangerous, so it's that availability bias. What's the worst case scenario? And then I'm more inclined to think about that. A lot of us don't think that we may become disabled. We don't necessarily know our neighbors or friends and family who become disabled, but we sure know about people who do die too early. So we think about what's likely to happen. Need to get disability coverage for ourselves and for our clients. And so for Jenny and Carl, we're going to talk about disability coverage. Remember, they need to get to retirement. That's all of our goals. That's all of probably your goals and your clients' goals. To get to retirement, that day I get to sail off into the sunset, just wear Hawaiian shirts all day, maybe only drink things that have an umbrella in them, maybe not even ever wear socks again, just flip-flops. Again, well, that might just be Florida people. Sorry for everybody in Michigan. You probably need to wear socks, to sleep. Probably cold all the time. So, our ideas of retirement are a little bit different. But we're going to talk about disability. How do we make sure they can get to retirement? The group term coverage that Jenny has available. Group long-term care offerings and how those compare to existing other options. And conversion. What happens when I have coverage through work or through my employer and I move on? What are my options to take it with me? So let's talk about disability first. So take Jenny, please. Sorry. Jenny's 39, and she makes just over $40,000. And she loves working with children. Look at that smile. She is super, super happy. She's not so happy that the state disability is employer paid. Well, she's happy about that. We all like something that somebody else pays for. And it covers 45% of her income. So right away, when we started looking at Jenny's disability coverage, we realized that there's a gap there. And so the question became, what is the cost for an individual disability policy for Jenny that helps to fill in that gap? So Jenny, we started looking at a supplemental policy for her, and it's going to be a non-cancelable policy, which means that it's guaranteed to be renewed every year she pays the premium, and the premiums are going to stay level until her age 65. And benefits are going to be payable to her age 65. So if she became disabled today, the payments would continue for over 30 years to her to make up for that lost income. It's going to have a 90-day elimination period because you as financial advisors recommend that your clients have a 3-month emergency fund. And so after they've exhausted that emergency fund, then the benefits would kick in and start being paid to Jenny. It's going to have an own occupation definition of disability. This is the most generous design, but one that most companies have. And so it says that if she's unable to perform the material and substantial duties of her occupation, and she's not working, then she would be able to receive the full disability benefits each month. We're also going to make sure that it has a residual or partial disability benefit rider that says if she decides to return back to work in her occupation, then as she returns to work and starts to make an income, she'll continue to receive disability benefits, but as her income increases, then the benefits she receives start to decrease. This prevents it from being an all or nothing. So we don't have a situation where there's a big penalty for her returning to work in a part-time capacity. And other options that we looked at, and again, these are all riders that I have on my own disability coverage. A catastrophic benefit rider that would pay an additional benefit in worst-case scenarios of disability. The future increase option rider that allows her to purchase additional benefits in the future if her income goes up without any new medical underwriting. And the COLA, or cost of living increase rider. The future increase option rider allows her to purchase additional benefits every year while she's still working. The COLA rider, if she goes on claim, increases the benefits she's receiving after she's been on claim for 1 year and every year thereafter. And our little guy over there on the left is just saying these are all choices that we have, and they're available on different policies. Most group coverage tends to be pretty simple, and so these are some riders that we can add that provide some additional benefits to Jenny. But we always want to know, what's it cost? All these things are great, Mark, but what does it cost? So for Jenny, we looked at what it would cost and how much she would be eligible for with 4 different disability companies. And so for company A, based on her income, and the maximum monthly benefit is based on her income, any group coverage she has, and each insurance company's calculations of how much they would qualify her for. So company A has a $1,190 monthly benefit that they would offer Jenny, and an annual premium of $712. Company B, more coverage. Their calculations are slightly different based on what they think the right replacement amount is, given her income, probably her taxes, what she nets on that, the existing group benefits. So company B would offer $1,335 a month for an annual premium of $953. Company C, well, smaller than the other two, $1,137 a month, but an annual premium of $1,395. So what that tells me is that with Company C, their financial guidelines are about the same as everybody else's, But Company C doesn't offer as favorable an occupation class to Jenny, being a teacher, as the other two. So part of what the pricing of a disability policy is based on the amount of benefits that someone's eligible for. As you can see with A and B, B offers more benefits than A, and so the premium's higher. But then what it tells me with C is that their benefits are lower than the others, but it has a higher annual premium. And so that means that Company C, their rates of claims for teachers are higher than with A and B. And so Company C says, for that same benefit, we think that she as a teacher is going to have a higher claim than other occupation classes. And so with Company C, it costs more because they think as a teacher she has a higher rate of claim. Company D looks about like the step from A to B, similar for C to D. So probably similar, C and D probably have a similar rate class and slightly different monthly benefit calculations. Now, when we look at supplemental coverage, it's great when clients can get it while they're still working. When they're still working, and in this case, Jenny's working at a school, she has a steady paycheck, steady income, she has the group benefits, everything's steady. Insurance companies like stability. And so a regular W-2 and a pay stub, that's stability. That's great. But life isn't always stable. And if you have kids, you understand that very well. So what if a new opportunity comes up? Jenny may have an option to go work at a charter school that maybe does or doesn't have any group benefits. So would the fact that she loses group benefits keep her from going to an exciting new opportunity at a charter school? I'm looking at those doors, and looks like a pretty cool school to me. Blue and orange, go Gators. But if any of you have been following the news, my exciting Gator season has come crashing to a halt. Or maybe she doesn't go work for somebody else. She says, you know what, I want to go work for myself, be my own boss. I want to be the big cheese, the big apple. Oh no, that's New York. The big cheese. So, I'm sorry, I'm hungry. I need a snack. So she says, I want to go start my own business. I want to go be a tutor. Well, with these new opportunities, if she moves to that charter school and they don't have group benefits, then there's different questions that come up about that existing coverage. It's likely that she can get new coverage. Let's say she didn't get the supplemental disability coverage when you recommended it the first time. And so she moves and takes a new job at the charter school, but it doesn't have any group benefits. What can she do? Well, in this case, because she's moving from just a different employer but the same occupation, she's a teacher, she's a teacher. She works over here, she works over there. She's still a W-2 employee. She's not working from home. She's going to have a regular paycheck. It's pretty likely that she could simply apply for new disability coverage because we have what disability companies like: stability. We have stability in the income. We have stability in the paycheck. So it's not not inconceivable that she could get new disability coverage since she'd go to work for a charter school. But what if she starts her own tutoring business? This gets much more difficult because there's no track record of earnings. When she moves to a charter school, she'll be an employee. She will continue to get paid. If she starts her own tutoring business, there's no track record of earnings. She may or may not be good at it. She may say, you know what, I'm going to start this tutor business, and I'm only going to work from 8 a.m. to 2 p.m. You know where all the kids are from 8 a.m. to 2 p.m.? They're in school. So Jenny's going to fail miserably. So we don't know if she's going to make it. But tune in tomorrow on Days of Our Lives. In December, we'll touch base and find out if Jenny makes it. But with new opportunities, if she'd only had the group DI, she can't take it with her. And that's just, with group DI, it's amazingly rare to find one that can be converted or be able to take it with you. But had she listened to you, then she would have the supplemental disability policy, probably with Company A that we looked at before, paying $700 a year for the $1,200 monthly benefit. And it stays with her. It's individually owned. It is tied to her, not to her employer. She can increase it later. She has that future increase option included on the policy that would allow her to increase the coverage just based on income, not new medical underwriting. So the group or the supplemental coverage is great. Even a lot of the future increase options have specific language that say if you lose group benefits, you have a 6-month window where you can exercise those future increase options early, or sort of an off anniversary exercise if you lose group coverage. So great to have, but easy to get when you're working. So get it while she's working. Remember, if she wanted to be a tutor and then get the disability, it may be very hard. But had she gotten the supplemental disability coverage, gotten it while she was working, and then moved to being a tutor, then she has that $1,200 a month, and can go on and start the tutor business. And then as she has a regular income, then she can go forward. Somebody asked a question: what happens if you have a disability insurance and you're a business owner, but you have to scale back to assist a disabled family member? Good question. When you have an existing individual disability policy, it will pay the stated amount if you become disabled. So if it's a $4,000 monthly benefit and you become completely and totally disabled, if you're not able to work at all, then the policy will pay in this case, $4,000 a month. If it has the residual benefit rider and you go back to work, then part of the calculations are going to be based on what was your income before you became disabled, and then as you return to work, it's going to residually adjust back to your pre-disability income. So if you were making $100,000 a year before you needed to help your family member, and then started making, cut back to half-time and were making $50,000, and then you became disabled, then the residual would reduce up to the $50,000. So at the point where you started making $50,000 again, the disability benefits would stop. Okay, and how about Carl? Well, remember, he's in the family business, and he's self-employed. We're going to leave Jenny back at the school. But then Carl, he's self-employed, and so he's kind of the flying carpet. It's good business, but they don't have a lot in the way of group benefits because they're still pretty small. And so what does Carl do? Well, when looking at what to do with Carl, I really like to phrase it this way and look at this question. Carl, you have a job, and we're going to offer you 2 different incomes for the exact same job. So Carl, which income would you rather have? So Carl, we can pay you $150,000 a year, and that'll be your annual income while you're working. But if you became disabled, which I already said was a pretty good likelihood before reaching retirement age, if you become disabled, well, we're going to pay you nothing. You say, okay, well, what's option B? We'll pay you $147,700 a year while you're working. But you know what? If you become disabled and unable to work, we'll pay you $83,000 a year until retirement age. You say, well, okay, what's the trick? No trick. All right. I think 99% of us would say option B. Well, option B, all option B is the same thing as option A with a disability policy. Option A is what Carl has now if he has no disability coverage. Option B, we pay a little bit every year for the possibility that if we become disabled, we'll still continue to receive an income for many years. So what does that policy look like for Carl? Well, we used a non-cancelable policy with benefits payable to age 65. Sound familiar? This is similar for Jenny, 90-day elimination period, own occupation definition of disability benefits. And for Carl, we use the same additional riders, the catastrophic benefits rider, the future increase option rider, and the COLA increase rider to give him choice. I have two questions pop up. One question, is the $83,000 taxable? It's not. It's tax-free because Carl is paying for it with after-tax dollars. It's an individually owned policy, so he's paying for it with after-tax dollars. So the $83,000 would be income tax-free. Another question, how does Social Security disability come into play with a private policy? I'm going to give a little bit longer answer than that. Social Security disability benefits will offset any group or employer benefits. So any group coverage that your clients have, again, I won't say always, but 99.9% of the time, group disability benefits have some sort of Social Security offset. So if it's 60% of my income from my group plan, any benefits received from Social Security will reduce that amount I receive from my employer. On a private policy, most of the time, if it's purely a base policy or just pure benefits from the policy, Social Security disability benefits do not reduce the benefits received from an individual policy. And of course, there's a but. But some policies have a Social Security offset rider, many times the SIS rider. So you may, a client may qualify for, let's say, $5,000 of monthly disability benefits. They can have all $5,000 of disability benefits through XYZ Insurance Company. And if they become disabled, XYZ Insurance Company pays him or her the $5,000. Or they may be able to blend it somewhat. That says, okay, I still qualify for $5,000 of monthly benefits, but $4,000 of that will be base benefits, and $1,000 will be the SIS rider. It saves a little bit in premium, but not an amazing amount so. And so that if I became disabled and I had policy option 2, the $4,000 and $1,000, then when I go on claim, insurance company XYZ is going to require me to file for Social Security disability benefits. And if I receive Social Security disability benefits, then they will reduce the benefits that they are going to pay by the $1,000. And so XYZ Insurance Company would pay the $4,000 and I'd get whatever amount from Social Security. Or if I apply for Social Security disability benefits and I'm denied, then XYZ Insurance Company will pay both $5,000, the full $5,000. So the $4,000 per month from that, and the $1,000 of the SIS rider, because they're saying we will pay the $5,000 per month, but if Social Security pays, we're going to reduce it. So a long answer to one question, but I wanted to touch on the difference between the group and individual policies and the fact that you have the option to include the SIS rider sometimes. Oh wow, they keep coming. What is usually the definition for own occupation for a small business owner? The definition is going to be built into the contract, and so own occupation, they're generally very general, generally very general, in that the language says something like your occupation is defined as the occupation you were engaged in when you became disabled. So if I am a baker when I become disabled, then they're going to define my disability as being able to not do the things that a baker does. Sometimes we have people get hung up in that I purchased the policy when I was a baker, but today I'm a CPA, and so but I bought the policy when I was a baker, and so if I became disabled today, will it cover me as a CPA? The answer is yes, because the language is very general in that it's your occupation is defined as what you were doing when you became disabled. It doesn't say in the policy that you bought it as a baker. Another question: if you're a business owner, don't you have the option of having your business pay the monthly disability premium? Benefits would be taxable, but you have a choice. Yep, that's right. That would be an option too. You could have the business pay the disability benefits, and anything received would be any benefits received would be 100% taxable as income. So you would have that option. In my case, I used the $83,000. I had Carl pay for it after tax. Good questions, everybody. All right. So let's jump back to Carl. So for his policy, with the $83,000 of annual benefits, his annual premium is $2,313. I remember my choice in jobs. I can get $150,000 a year and nothing if I become disabled, or I can take $147,700, and if I become disabled, I still get $83,000 a year. Carl, he has a wife, has a child. He says, you know what, I really like this idea that if I become disabled, then my family continue to still get an income. But he says, you know what, I am male, so I am cheap, and so is there a way that I can even maybe squeeze another dime out of this and not even pay quite that much? Sure, also being male, I appreciate that. So what I looked at is taking the same basic policy, but getting rid of two riders, the catastrophic benefits rider and the COLA increase rider. Why did I pick those two? Because most group plans don't have those riders included. Group plans will have an elimination period, benefits payable age 65. Most group plans usually have a residual or partial disability benefit rider built into it. And most group plans don't really have a future increase option, but it's stated as a percentage of income. So as my income goes up, then I would get more of a benefit. 60% of a higher number is a higher number. And so I leave the future increase rider onto this policy. And instead of $2,313, Carl's premium is $1,846. Well, he likes that even better. So now we ask Carl the same question, or he asks it to himself in his head. Instead of $147,700, could he get $148,154 and still get $83,000 if he became disabled? Again, I like option B even better than the first option B. So that's what we can do for business owners, self-employed clients, people without disability or group benefits. And I think I really like this framing the conversation, because if we say, do you want disability coverage, most people would say, nope, I don't know anybody who's disabled, but they probably do. But phrasing in this way, which income option would you rather have? I think option B makes it clear. Group term. Well, the first $50,000 is tax-free when paid by the company. Well, I love that. The employee only pays the tax on the premiums on amounts over $50,000 that the employer pays for. So the first one is free. Great. Second, instead of paying premiums, I'm just paying the tax on premiums. I like that a lot. But then we're going to talk about group supplemental term. So the first two are things that the employer is paying for. Now we're talking about anything that the employee is paying for. Well, group supplemental term, the costs increase every 5 years, may or may not be guaranteed issue, simplified underwriting. So it may be a good option for clients with some health challenges or underwriting challenges. And it's generally very inexpensive when clients are really young, but prices jump. And so for the employee-paid group supplemental life, generally simplified underwriting, just a few rate classes. Premiums are really low when clients are young, but the rates go up every 5 years. It's usually formula-driven, X of 2 or 3 times salary. And so for, especially if you're younger clients, that's generally not enough when you have kids, a mortgage, years to retirement. Is it convertible? You may be able to trade that term for permanent coverage, but many times it's not very competitive, and we're going to go through an example later. Is it portable? You generally don't have the option to keep the group term as group term. You usually have to convert it to something else if you want to take it with you. For individual life insurance, well, paramed exams are required. There are multiple underwriting classes like the super preferred rates or standard or table 2. And when you're healthy, over the long term, the individual term is always going to be the best. But when you look at just pure dollar for dollar and annual premium, about age 40, 45, individual life is going to be better than group term. We can guarantee the premium for the level of the selected term. We can get as much as anybody needs or wants or qualifies for, not tied to just 2 times salary. The conversion is available through the conversion option of the policy, generally to age 70. And is it portable? Yes, because I own it. I own it myself. I can go to whatever job I want, and I own this policy. So how do we compare? Well, let's look at a female for $250,000, her annual premium for her group rates. Well, when she's in the first bracket, which is 30 to 39, the annual premium is $165 for that $250,000 group term. If we wanted to lock that in at age 30 for a 30-year term, well, the annual premiums are $225 to $263. Now, what's hard sometimes, especially for younger clients, to wrap their heads around is that, yes, the 30-year term is more, but that's locked in for the next 30 years. Where for that 35-year-old, she'll pay $165 for the next 5 years, and then $207 for 5 more years, and then $327 for 5 more years, and $567 for 5 more years. It will keep going up. But then let's look at our age 45-year-old. The group term, just for her at age 45, is $327. If she's a super preferred, it costs $274. If she's preferred, $312. So not only, we don't need a long-term horizon and 1,000-yard perspective here, it just costs less. And so the earlier the client is, they need to be able to understand that I pay more, but I've locked that in for the next 30 years. When you get into the 45-year-old, 50-year-olds, it's just lower. So Jenny, who's age 39, has this different amount of coverage here. She has the $164,000 that's group coverage and doesn't cost her anything. And she's paying for an additional $328,000 of group supplemental term. And she's paying $434 per year while she's working. What's that last column? It's the cost per $1,000. I include that so it's a way to compare apples to apples. If we just looked at the dollar amounts, it gets hard to compare when we have different term amounts and different total amounts of coverage. So how do we compare them to each other? The cost per $1,000. And so for her group supplemental, she's paying $1.32 per thousand. And she has a $250,000 20-year term policy that she got 11 years ago. And for that one, she's only paying 84 cents per thousand. So right now, 0 wins, free's always best. Then her second most efficient policy is the group term, is the supplemental term she got, and then her supplemental term is sort of the third one. But she needs about $1 million today. So what do we look at? Well, we can add a $258,000 15-year term, $475 per year. And it guarantees that for the next 15 years, and cost per $1,000 is $184. So looking at that, It's higher than what she's paying for her group supplemental today, but we know that's locked in for the next 15 years, where we know that the group supplemental is going to increase next year when she turns 40. And the total premium, $1,117 per year. We know that the coverage is increasing. And so she says, you know what, I really am not comfortable with that instability. I know that it's going to increase next year and even 2 more times. So I'd rather just lock it in today. And so what we did is we looked at a $586,000 15-year term policy, $984, and the cost per 1,000 is $1.68. What we have here is that the individual coverage is priced in bands, like breakpoints in the mutual fund world. And so to get over the $500,000 amount, the cost per dollar of coverage got more efficient. And so while it costs her a little bit more than what her group supplemental coverage was going to be this year, it saves her money compared to next year and then every year going forward. Now Carl, he has a $250,000 20-year term policy that he purchased at the same time that Jenny did. And then during open enrollment 1 year, then they added a $100,000 spousal group term for Carl. Look at that cost per 1,000, $2.33. Spousal group coverage tends to be very, very pricey. At least with the employee, the insurance company knows that Jenny is healthy enough to be working there. They know absolutely nothing about Carl. So the costs for Carl are very high. And generally it's $25, $50, maybe $100,000 in coverage that they're able to insure a spouse for with no underwriting. But he's in good health. He needs $545,000 of coverage, add a new group term, or add a new supplemental term, drop the group. So for Carl, this is much more of a no-brainer. There's no, knowing that the other one will be more expensive next year, but not necessarily this year. Carl, the spousal group term is just pricey. And so we improved his situation quite a bit. Now what about long-term care insurance? Well, take a look at them here in this picture. They're pretty young. They're kind of young to be thinking about long-term care insurance. But it's offered through Jenny's employer. And so it's something they can sign up for. And, she got the mailer in her, cubby where all the teachers go to check for paperwork and permission slips and stuff like that. And, there was this flyer about long-term care insurance. I hadn't really thought about it. But they bring it to you, and they ask you what you think. You say, I'll get back with you. And then you ask me, and I'll tell you what I think. I've never been shy about that. So what are people in the room are laughing when I said that? Wow. Huh. What about long-term care? Well, what are the pluses to group long-term care insurance? Unlike a lot of the group term or group disability coverage, you can take it with you. It's offered to employees, and there's the rates don't change simply because you retire or you leave. You have sort of a certificate to a group plan, and you have your own, not really your own policy, but you have your own certificate, your own premiums. There's generally limited or no underwriting to it, and many times there are nice discounts to it because it may, it may cover hundreds, if not thousands, of people. Some of the minuses or disadvantages is that there are usually a limited number of options. You may have $100, $150, and $200 daily benefit option. You may have no choice on the elimination period. Maybe one inflation option and a 3 or 5 year benefit period. There tend to be no spousal discounts because of the group coverage. There's usually some sort of a multi-life or larger group discount, but not a spousal discount. One thing that spouses really like is the shared care coverage, and that tends not to be an option, or I've never seen it as an option on group long-term care coverage. So what about Carl and Jenny? Well, they have an option through their employer to sign up for a long-term care policy that has a $200 daily benefit, 90-day elimination period, 3-year benefits each, and a 4% compound inflation rider. And so part of what you did is you called me, or you called Jill in our office and said, Jill, if Carl and Jenny took out this policy today, what would it cost? Well, for 2 individual policies today, their combined monthly premiums would be $768 per month. But through the group plan, only $228 a month. So group long-term care tends to be a newer solution. And part of this comes down to pricing, where with individual long-term care policies, there's the underwriting and people are looked at individually, and insurance companies have a lot of claims experience on individuals. With group long-term care plans, there tends to be more underwriting based on just that particular block or employees. And so if you follow me for a second, say somebody has a group plan that's 10 years old. They've pretty much only insured people who are working. And so all of their people right now are working. The oldest person in that plan would be somebody who retired 10 years ago. So they tend not to have had lots of claims on people in their 70s and 80s, where individual coverage has. But still, every year that if they really were concerned about long-term care, and Jenny's mom had Alzheimer's and saw Andrew go through that with her, it is something they're interested in, had thought about. They looked at this, saw that there was this group plan premium that was that much left. And like the great Steve Miller says, go on, take the money and run. Sign up for the group plan. Do we think that those premiums are going to go up? Absolutely. But every year that they may pay less than fair market value for that policy, even with the increases, they're still ahead of the game. It's sort of like buying a 2014 car instead of the brand new 2015. It's a month older, but it's got a discount to it. So maybe you have to get a car a month earlier. Every year that you paid a little bit less and you had that car for all those years, you were better off. Same thing with the group long-term care policy. Expect the premiums to increase. Talk to the clients about that. Expect that they're going to go up when we know what the cost for policies are out there today. But no reason, I still think they should sign up for it and lock that in, and every year they have it, they can keep going. And so the last thing we're going to talk about is what happens if they leave. Well, last month, and in the introduction, we teased you with what happens if Jenny gets fired for an inappropriate Facebook post. Well, realizing that this needs to be a G or PG rated webinar, I went no graphics. But Jenny, she posts, I hate my boss. Lizzie, who obviously isn't the best with grammar, so she's probably not an English teacher, says ditto. Guess that's supposed to be ditto. Just sad. Jenny doesn't have very good friends. Jeremy is her boss. So you do realize we're friends on Facebook, right? So Jenny was escorted out of the building very quickly. So what does she have? Well, she's got to pack up her stuff, and since she's no longer working, she says, uh-oh, I'm going to lose that group life insurance I had. So the HR person sends her a big old packet of all the different things she can do. And she has the ability to convert her group term. And it's a $336,000 death benefit that her policy's grown to, and she can convert it to permanent coverage. And the annual premium will be $10,779. Well, right away we know, well, Jenny ain't got no job. So where's she going to come up with the $10,000? It seems kind of, like, just kicking somebody when you're down. But that's what it is. That's what it costs. So how does that compare to what else you might be able to qualify for? Well, assuming a standard rate class, $336,000, even a 30-year term at her age, would cost less than just over $2,000 a year for the same death benefit. And if she really wanted permanent coverage, instead of converting to that permanent policy that's being offered, and she's standard health, she can pay just under $3,500 a year. So it's not a great deal. What if she's preferred? She's actually preferred. She's in better than average health. A 30-year term, under $1,350 a year. The permanent coverage, under $3,000 a year. So group term conversion is very pricey. How pricey? Well, I tried to compare it to an existing, what sort of rate class is assumed when she converts it. Remember, it was probably guaranteed issue or simplified underwriting or had little to no underwriting when she got it. May not have even asked, if she's a smoker. I'm sure it didn't ask if she's had cancer or heart disease. Probably guaranteed issue. So she automatically got it. She could have 1 foot in the grave and 1 foot on a banana peel, and she would have been able to get that group coverage and pay the same rate as the person next to her who's a perfect specimen. So she can convert that $336,000 and pay $10,779. So I looked at what would she be able to get on a permanent coverage, or what sort of rate class would that same premium apply to a $336,000 life insurance policy if she applied today? Well, a Table H premium is $10,198. And for the particular companies I was looking at, you couldn't go higher than a Table H. What is a Table H for many of you? You have different underwriting classes, and so you have super preferred, preferred, standard plus, standard. Then table ratings are a substandard rate. So you have super preferred, preferred, standard plus, standard. Table A, table B, table C, table D, table E, table F, table E. So all the way down to table F. So it would be as if she applied today, that would be a highly substandard policy to almost a point where a lot of insurance companies don't offer tables higher than table H. So it's really not a great deal for anyone unless they really, really can't get coverage elsewhere. I love this graphic. There's my sliding scale, all the way from preferred plus to table H. It's like that she is paying for a table H premium for someone who is on the borderline of being insurable. So for Jenny, for the disability, on the left, right there, she listened. She got the supplemental disability coverage. And so she knows that if she goes to start that tutoring business and instead she'll work nights instead of during the day, she's got that supplemental disability policy that's following her wherever she goes. Or if she goes to that charter school, and the charter school principal, well, you know what? She really doesn't like her boss either. What was his name? Jeremy? Jeremy. She thinks Jeremy's a jerk too. So she laughed about that Facebook post and said, hey, Jenny, I don't like Jeremy. Come work for me. I've got a job opening for you. We don't have group disability. And Jenny says, great, I'm the smiley face right there. I can just come work for you, and I'll exercise that FIO benefit rider. Or she could be a sad face emoji. She didn't listen to you when you said, you know what, you really should get that supplemental coverage while you're working. And so now she doesn't have any supplemental, she doesn't have any disability coverage, and she's looking for a job. It's getting tougher for her now that she's going to start that tutoring career. The long-term care insurance, Well, they'd signed up for it, and so it's great. Remember, long-term care insurance was the one thing I said really doesn't change when you move from being employed or not employed. So they're sailing away, they're driving around in their convertible, again, just living up on the beach. There they go, over on the left, not wearing any socks. There they are, living the high life. And Carl, hopefully he listened too. He wasn't fired, but now he's the sole breadwinner. So hopefully he listened, and he said, you know what, I really would like income B instead of income A, and got the disability coverage. We helped him get that life insurance coverage, so in case anything happened to him, then they have income replacement for the family. Long-term care insurance, again, age 39, we're making sure that disability and life insurance are all taken care of, but then starting the conversation about the long-term care insurance. Because right now we're more worried about him earning an income and getting to a retirement age, and then long-term care insurance really sort of takes over when we're worried about spending down what we have, not that we haven't saved enough for retirement. And so we talked about disability coverage, group term, long-term care insurance, and conversion, meaning what can we do when we move from employee to self-employed, employee to sort of fired, but all the different things. How does getting the coverage in place while we're working and having that stability help mitigate the instability later? And if anyone would like to type in questions, go ahead and do that right now. I'm about to wrap up. But join us next month for Insurance Challenges of Unusual Occupations and Non-Working Partners, starring Claire and Tony, narrated by Jerry Skapiak and Kathy Bilodeau. Can self-employed Tony get the insurance coverage he needs? Will Claire's health scare drain the family finances and end David and Daniel's surfing careers since she's their manager? Will Jerry and Kathy talk like this? Find out next month. Well, and did you know that we will be presenting at a number of different places and times over the next month or two? We'll be presenting at the ACP conference next month, the PICPA next month as well. We'll be hosting a Genesis webinar, an XYPN webinar, Garrett member webinar. I will actually be presenting next week at the NAPFA conference in Indianapolis. Don't forget to come walk the walk with us for our LLIS Insurance Academy, February 4th through 5th, 2016, right here in the beautiful Sheraton Tampa Riverwalk Hotel. I can't guarantee that it'll be warm, but I'll guarantee it's warmer than wherever you're coming from. And for those of you who are new to us, there are a number of things that make us different, like the free monthly webinars that we host for advisors. We have 2 more coming up this year. And we're not your competition. Talked with the advisor this week and last week who are looking for people to help with the insurance, but understand how fee-only advisors work. It's really fun to talk to new people because our only clients are fee-only advisors. And we do our best to save you time and your clients money. We pre-underwrite to avoid surprises, and we do a lot to provide advisor tools and client tools on our website. We are proud sponsors of a number of different fee-only financial planner groups. We have product specialists in the topics that I talked about earlier today, as well as annuities, hybrid life and annuity long-term care policies. We keep you and your clients in the loop with our AIM or application information message. And we help you and your clients manage their policies, not just now, but in the future, with our advanced premium emails and our notes, our notification of term expiration emails. One question came up, can you comment any more on disadvantages of professional association non-employer group DI? And I know that there are plans that either, I know there's some available for financial planners like the NAPFA group plan. You have doctor clients who may be able to purchase association coverage. It's sort of a hybrid between a group plan and an individual policy. It usually has a stated amount, which is more like an individual policy, where a true group says it's 60% of your earnings. And part of the question was they seem extremely cheap in premium. And I agree. I think all of those things are good base or starter policies. But we do see things where association plans, they can be canceled, they can be changed, and so it's not not always that just because you have a policy it means that you always will have a policy. So it's great to have those as base plans, but then supplemental coverage policies that are truly individually owned that can follow you wherever you go. Again, with the associations or groups, usually you're only eligible while you're a member of those groups. And if you decide to change group affiliation or association affiliation, then you may lose that coverage. All right. Well, thank you, everybody, and tune in next month for a webinar. And I hope I will see many of you in Indianapolis next week. And I bet it will be colder than where I'm from. So thank you, everybody, and have a great rest of your day.